We just reached a new milestone in the mortgage market since the Federal Reserve recently eclipsed $1 trillion in mortgage-backed security purchases since March of last year. I want to talk about the significance of this trend, as well as if there's anything we should do for the future when it comes to investing in real estate or just looking at the real estate market in general. But before I get into that, just want to introduce myself for anyone who's new to the channel. My name is Jack Duffley, and I'm a 24-year-old real estate investor and attorney. And on this channel, I cover a variety of topics as they have to do with real estate, investing, the markets, and pretty much everything as it has to do with personal finance. So if you like that sort of content, be sure to have a look around the channel. And if you like what you see, be sure to subscribe. So this chart given to us by the Federal Reserve, otherwise known as the Fed, tells us the amount of mortgage-backed securities that are held by the Fed. You'll notice that the Fed didn't start buying mortgage-backed securities until about 2009 and has really continued ever since, with occasional sell-offs followed by massive spikes in the amount of mortgage buying. Now, in order to understand this chart and what it actually means for the mortgage industry, it's important to understand how the mortgage industry actually works. For many mortgages in the United States, they conform with Fannie Mae and Freddie Mac guidelines. And these are two very large government quasi-corporations that are responsible for issuing a lot of mortgage regulations because they are one of the chief buyers of mortgages. And that's important for a few reasons, because Fannie Mae and Freddie Mac aren't usually issuing the mortgages directly. Instead, what happens is a bank will offer a mortgage product to someone who wants to buy a home. They'll issue that mortgage to the person, and then the bank will not hold on to that mortgage and instead will sell it to someone like Fannie Mae or Freddie Mac as long as that mortgage meets those guidelines. And this goes for other programs as well, like FHA and VA. It's just that Fannie Mae and Freddie Mac are the largest of those government conforming loans. All they really have to do is make sure they're conforming to the rules, and that's typically what takes the longest in actually getting a mortgage if you've ever bought a home before. They're making sure that you fit all of the criteria that go into approving a Fannie Mae or a Freddie Mac or whatever sort of government-backed loan it is, since that is the most common type of mortgage. If the bank didn't have a buyer on the other end like that, they probably would have to raise their interest rates because there's less demand for the mortgage that they have at that low interest rate. And as an investor, in this case Fannie Mae, you could kind of look at as an investor in the mortgage, they'd want mortgages with higher interest rates since that means it's more profit for them. But in this case, because everything is subsidized through the government, it's not your typical sort of corporation, Fannie Mae or Freddie Mac. They're trying to entice homeowners to take out new debt, to buy new homes, and stimulate the mortgage market. So that's why rates can be so low. But that's not where the trip ends. Once Fannie Mae or Freddie Mac buys the mortgage, they'll package it together with many other mortgages that they've also bought from other banks and create what's called a mortgage-backed security. And this is like a basket of mortgages, and they're usually going to range in credit rating. You got your A+ mortgages, B, C, and beyond, because you're trying to have a diversified basket of mortgages to the point where any of those worse off mortgages that might be at a higher interest rate and thus more profitable, they also have a higher default risk. And you want to make sure that you can cover those with some of your better mortgages. And that's because Fannie Mae and Freddie Mac is not going to hold on to these mortgage-backed securities and instead will sell them to things like pension funds, even back to banks, especially larger banks that offer things like pension funds and investment products. But it'll also sell it to a very big buyer of these securities, and that is the Federal Reserve. And in the last 16 months, since March of 2020, the Federal Reserve has bought, on average, about $80 billion in mortgage-backed securities per month, to where now we're at that total of about $1 trillion since March. But what would happen if the Fed stopped buying these mortgage-backed securities? Well, it would cause a ripple effect in the entire mortgage industry. Because the Fed would be buying less mortgage-backed securities, Fannie Mae and Freddie Mac and those government agencies would have less people or things to sell their mortgage-backed securities to. And because they'd have less buyers, they'd also have less demand for such low-rate mortgages from the banks that they make the initial purchases from. So banks would have to increase their rates. That's a big way in how mortgage rates are kept so low in the United States. It's because at the end, someone with a very, very deep pocketbook is buying those mortgages at pretty much any price. And that deep pocketbook is really unlimited given the amount of printing that the Federal Reserve can do. And because there's less demand for mortgage-backed securities, that would mean there's less demand for mortgages on the investment side, so buying the actual finished mortgage products. And because of that, banks would want to raise the interest rates on these mortgages to make them more attractive for ultimate investors. And in the limited history we have of the Federal Reserve owning mortgage-backed securities, we see that every single time they've tried to remove mortgages off the balance sheet, they end up buying many more in return once things get a little dicey in order to keep rates as low as possible. Because if rates were we're allowed to go up, that would mean that real estate prices would come down, because for every dollar that you put into a new loan product, you'd be able to get less money in return because you'd have to be paying for more interest. So if that happens to everyone across the board who's applying for mortgages, that would decrease demand and thus decrease the price of real estate across the board. Of course, you could probably cherry pick examples of markets that would do good, but across the board, that's what would happen. So the Fed has put itself in a very peculiar place. If it stops buying mortgages, then mortgage interest rates would go up, since it's such a huge buyer of mortgages right now and really has been for the last decade. But if that happens, be ready for real estate prices to come down, and be ready probably for the price of many financial assets to come down. That's one thing that the Federal Reserve is very good at. It's good at propping up asset values in the short term. So how do you approach this strange situation if you're looking to buy a home or you're looking to get an investment property? How do you approach real estate in this sort of environment? Well, like the video I put up a couple days ago, you definitely have to look at the individual deal. If you look at the whole market, you can cherry pick a number of different bad catalysts, this being one of them. How is this really sustainable? It probably isn't, but you can't get caught up in that. Because first off, who knows how long this could last? This could go for another decade or two, and then you'd be missing out on all this potential gains, even if there is an ultimate collapse 20 years from now. 20 years is a long time. But even in a market that's been propped up by many different government actions, including the Federal Reserve's buying, you can still find great deals. They might just be very hard to come by, much harder than they might be in another time. Because in a bad market, especially if the Federal Reserve stops buying mortgages, or at least as many, it'd probably be harder to find credit anyways. So it's not as though it's going to be much easier to buy a great deal at that point either. Whatever you do, you got to look at the fundamentals of the deal. How much cash flow could this property bring in? What would happen if the property lost 25% of its value overnight? Could you still hang on to it as long as rent would be preserved? Look at the actual market it's in. Does it have good tailwinds or not? But do realize that these crazy low interest rates, like the 2.99% 30-year fixed rate mortgage that I'm about to get on the property that I'm close to closing on, realize that those don't exist in the wild. They exist because of government subsidies and ultimately the Fed's buying program. They allow banks to pass on the risk to another entity, whether it be Fannie Mae, and then Fannie Mae ultimately to the Fed. It's just kind of sharing the risk down the stream, and that way banks can keep dishing out these super low rate mortgages. Say what you will about that system, but that is a very simple explanation of how it works. But otherwise, that's all I've got for today. So if you like this video, please like it, since that would help the channel out a lot. And if you like this sort of content about the markets and investing, then definitely subscribe, since I put out new videos every single week and wouldn't want you guys to miss out. And check out the free stuff and the affiliate links in the description below. But until next time, take care.